The invisible pattern Wall Street ignored. It didn't appear as a crash, a scandal, or a breaking headline. It surfaced quietly, buried inside routine market data, invisible to most of the world. Yet this single pattern, missed again and again, was already shaping outcomes worth billions. To understand why this matters, we have to step into a time when markets felt efficient, sophisticated, and fully understood. Models grew more complex. Data became abundant. Confidence followed. Wall Street believed it had tamed uncertainty with algorithms and historical precision. But that belief created a dangerous blind spot. When everyone trusts the same framework, anything outside it becomes invisible. This story matters now because markets still rely on patterns we assume are complete. Investors still trust models built on yesterday's behavior. And entire systems still dismiss signals that don't fit established narratives. The pattern at the center of this story wasn't hidden because it was subtle. It was hidden because no one wanted to see it. The first reveal begins with an analyst working far from the trading floor noise. He wasn't searching for alpha or chasing headlines. He was reviewing routine historical data, volatility clusters, correlation shifts, timing anomalies. And as he layered years of information together, something felt wrong. The data behaved logically in isolation, but strangely when viewed as a whole. He noticed recurring distortions that appeared just before major market moves. Not every time, not predictably enough for headlines, but consistently enough to raise concern. These distortions didn't signal direction. They signaled tension, pressure building beneath the surface, while prices stayed calm. The second reveal came when he compared these distortions across different market cycles. Booms, corrections, crashes. The same pattern appeared repeatedly, always dismissed as noise, always written off as temporary imbalance. Yet it appeared before stress events more often than chance allowed. It was a structural warning, not a forecasting tool. The third reveal emerged when he realized why no one noticed it. The pattern lived between models. Too small for macro analysis, too broad for micro signals. It didn't belong to any established category. And because it couldn't be labeled, it couldn't be acted on. The analyst understood something unsettling. Wall Street hadn't ignored the pattern because it was wrong. It ignored it because it didn't fit. And that realization marked the beginning of a much larger reckoning. He began isolating the pattern, stripping away everything the models insisted was important. Earnings surprises, news events, policy announcements. None of them explained what he was seeing. The distortion appeared even on quiet days, even when headlines were empty and sentiment looked calm. It emerged from the structure of the market itself, not from information flowing into it. As he dug deeper, the pattern revealed its true nature. It formed when liquidity behaved unevenly, when capital moved freely in some corners of the market while tightening invisibly in others. Prices didn't react immediately because surface liquidity remained intact. Trades still cleared. Volume still looked healthy. But beneath that surface, depth was thinning in specific instruments that most models treated as interchangeable. This was the early conflict. The analysts realized the market wasn't unstable. It was asymmetrically stable. Some areas absorbed stress, while others quietly stored it. The pattern marked the moment when risk stopped being shared evenly and started concentrating silently. And concentration, he knew, is what turns ordinary volatility into systemic events. He tried presenting the idea cautiously, not as prediction, not as a warning of collapse, just as an observation worth exploring. The response was polite, then dismissive. Senior analysts argued the distortions were statistical artifacts. Risk managers pointed to healthy averages. Portfolio managers shrugged. If prices weren't moving, they saw no problem. Markets, they insisted, had evolved past such fragility. But the analyst couldn't let it go. He tested the pattern against past crises with stricter controls. When he removed hindsight bias, it still appeared. When he randomized inputs, it disappeared. That mattered. It meant the pattern wasn't accidental. It required real market conditions to exist. And those conditions were becoming more frequent as trading grew faster, more automated, and more interconnected. The conflict deepened when he realized something else. The pattern grew stronger when passive strategies dominated flows. Index rebalancing, programmatic hedging, risk parity adjustments. None of these strategies were flawed on their own, but together, they created synchronized behavior that drained liquidity from the same places at the same time, without anyone intending it. The market looked diversified. In reality, it was harmonized. He flagged this internally, emphasizing that diversification assumptions were weakening. The response was colder this time. The firm's success depended on those assumptions. Questioning them meant questioning the foundation of modern portfolio construction. And foundations, especially profitable ones, are rarely challenged willingly. So the analyst kept working alone. He mapped the pattern forward in real time, watching it strengthen during periods of calm. Each week it appeared without consequence. Confidence in the market grew stronger, and that, paradoxically, made the pattern more dangerous. Because the longer pressure builds without release, the more violent the release tends to be. By now, the analyst wasn't trying to predict a crash. He was trying to answer a different question entirely. What happens when everyone believes risk has disappeared, while it's actually pooling in places no one is watching? The data suggested an uncomfortable answer, and the market was moving closer to proving it. The answer began forming during a period of near-perfect calm. Volatility sat at historic lows. Credit spreads stayed narrow. Equity markets drifted upward with steady confidence. Commentators spoke of a new normal, one where shocks were absorbed instantly and risk was mathematically contained. Yet the analyst's pattern was flashing brighter than ever. He watched liquidity maps tighten in the same pockets week after week. Instruments once deep and resilient now relied on fewer participants. Market makers stayed present but thinner. Algorithms provided volume, but not commitment. It was liquidity that vanished the moment it was needed most. And that distinction mattered more than price itself. The conflict intensified when the analyst overlaid stress simulations on live data. Under small disturbances, the system looked stable, but under moderate stress, the pattern triggered rapid correlation spikes. Assets assumed to be independent began moving as one. Hedging failed. Diversification collapsed. The model didn't predict disaster. It revealed fragility. He escalated the finding one last time. This time, the pushback was sharper. Leadership argued that modern markets were designed to handle exactly these scenarios. Circuit breakers, central bank backstops, high-frequency liquidity. Every safeguard was cited as proof that the past no longer applied. The analyst listened, then quietly ran the simulations again, this time removing one assumption at a time. When he removed continuous liquidity, the system cracked instantly. That was the moment everything clicked. The pattern wasn't predicting a specific event. It was identifying a condition where markets require perfection to function. No delays, no hesitations, no surprises. And systems that require perfection don't fail gradually. They fail suddenly. The buildup accelerated as real-world signals aligned with the model. A brief funding hiccup here, an unexpected spread widening there. Minor events, quickly resolved, yet each one left residue behind. The pattern absorbed those stresses instead of releasing them. Pressure climbed, invisible to price, invisible to headlines. The analyst stopped thinking in terms of if, and started thinking in terms of when. He knew the trigger wouldn't be dramatic. It never is. It would be ordinary. A policy comment, a missed auction, a routine rebalance gone wrong. Something small enough to be ignored until it wasn't. The system didn't need a shock. It needed a spark. And as the pattern reached its most extreme reading on record, the analyst realized the market was standing on a knife's edge, balanced not by resilience, but by silence. The next move, whatever it was, would decide whether the pressure dissipated quietly or released all at once. The spark arrived without warning, just as he expected. Not a crisis, not a collapse, a routine event, ordinary enough that it barely made the news. A small shift in funding conditions, brushed off as temporary, but the moment it happened, the pattern reacted instantly. Liquidity thinned where it had already been fragile. Correlations jumped where diversification was assumed. Algorithms adjusted simultaneously, pulling back in the same places at the same time. What looked like a minor disturbance became a rapid chain reaction. Prices moved not because of fear, but because the system had no room left to absorb pressure. Within hours, volatility surged. Assets that had never moved together began falling in unison. Hedging strategies failed exactly as the simulations predicted. The market wasn't panicking. It was recalibrating all at once. And recalibration, when delayed too long, is violent. The analysts watched as the invisible pattern finally surfaced in plain sight. Commentators scrambled for explanations. Some blamed sentiment, others blamed policy. A few blamed technology, but none of them saw the deeper truth. This wasn't a surprise. It was a release. Pressure that had been pooling quietly now had an exit. The climax wasn't a single crash. It was a realization. The market had not become safer. It had become quieter. Risk hadn't vanished. It had concentrated. And concentration, once exposed, reshapes everything at once. In the days that followed, emergency measures stabilized prices. Liquidity returned. Confidence crept back. To most observers, it looked like another episode survived, another scare absorbed. But the analysts knew better. The system hadn't been fixed. It had been reset temporarily. The resolution came with a sobering lesson. Modern markets don't fail because they lack intelligence. They fail because they rely on shared assumptions. When everyone uses the same models, the same data, the same logic, blind spots become systemic. What we don't measure doesn't disappear. It accumulates. The invisible pattern was never a prophecy. It was a warning, a reminder that stability built on silence is fragile by design. And as markets grow faster, more automated, and more interconnected, those warnings matter more than ever. Because the next time pressure builds as quietly, the release may not be so forgiving. Subscribe to join the journey.